Harry and Tony had more in common than most people would expect. They were both young professionals preparing for one of the biggest milestones of their lives. Both were engaged to women they deeply loved. Both dreamed of a beautiful wedding surrounded by family and friends. And when they realized they didn't have enough money to pay for everything they wanted, they both made the same decision. They borrowed money. If you had seen them that day, you would have watched two men sign loan agreements. Nothing about that moment suggested their futures would be dramatically different. Yet 5 years later, Harry was still sacrificing part of every paycheck to repay a debt that gave him nothing in return. Tony had already cleared his loan, expanded his business, and was using its profits to build wealth for his family. The surprising part? Tony actually earned less than Harry. So how did the lower-income man become wealthier? The answer had very little to do with income. It had everything to do with understanding the difference between borrowing to consume and borrowing to produce. Most people think debt is either good or bad. The truth is simpler. Debt is a tool. Like fire, it can warm your home or burn it down. Its value depends entirely on how it's used. Understanding that distinction can permanently change the way you think about money. Let's begin with Harry. Harry earned about $50,000 a year, a respectable salary. Yet he constantly found himself with little money left at the end of each month. His problem wasn't low income. It was spending. Every raise came with a bigger lifestyle, a better apartment, a newer car, more expensive dinners, better vacations. Without realizing it, Harry had fallen into lifestyle inflation. Saving became an afterthought. Then came the wedding. Harry wanted everything to be perfect: a luxury venue, premium catering, elegant decorations, professional photographers, live entertainment, a celebration people would remember for years. There was only one problem. His savings couldn't support that vision. Instead of asking, "What wedding can we comfortably afford?" Harry asked, "How much can I borrow?" The bank approved the loan. Almost overnight, the wedding became possible. On the big day, everything looked perfect. Friends laughed. Family celebrated. The photos were beautiful. For one day, it felt like the loan had solved every problem. Then morning came. The flowers wilted. The decorations disappeared. Guests returned home. The celebration became a memory, but the loan remained. Every month, Harry made payments for something that no longer produced value. The loan created no income, no asset, no business, no additional earning power. Instead, it reduced his future choices. Investing had to wait. Buying a home became harder. Building an emergency fund became more difficult. The loan didn't simply finance a wedding. It quietly borrowed against Harry's future. Now let's look at Tony. Tony earned slightly less than Harry, yet he approached money differently. He and his fiancée also wanted a memorable wedding, but they accepted a simple truth. A wedding lasts one day. A marriage should last a lifetime. Instead of borrowing to impress guests, they planned a wedding they could comfortably afford. Some friends questioned the decision. Others encouraged them to take a bigger loan. Tony ignored the pressure. He understood that a wedding is meant to celebrate commitment, not display wealth. Choosing a modest celebration wasn't sacrificing happiness. It was protecting their future. Tony also borrowed money, but not for the wedding. Months earlier, he had researched a small business opportunity. He studied demand, estimated costs, calculated expected revenue, considered the risks. Only then did he apply for a loan. Notice the difference. Harry borrowed to improve his lifestyle. Tony borrowed to improve his income. That single decision changed everything. The business wasn't an overnight success. Most businesses aren't. Tony worked his regular job during the day and built the business at night. There were setbacks, unexpected expenses, long hours, moments of doubt. But every challenge taught him something. Gradually, customers returned. Revenue became consistent. Profits followed. Soon, the business was generating enough income to cover the loan repayments. Eventually, it generated far more. This is what people mean by good debt. Good debt isn't defined by low interest rates or by the type of loan. It's defined by purpose. Good debt helps acquire something that has a reasonable chance of producing more value than it costs. A business, a rental property, education that meaningfully increases earning potential. The common thread is simple. The debt helps create future income instead of financing present consumption. Banks understand this principle. Loans tied to productive assets are often evaluated differently because those assets may generate the cash flow needed to repay the debt. While success is never guaranteed, an income-producing asset has the potential to help pay for itself. Harry's wedding couldn't make a loan payment. Tony's business could. That single difference completely changed the role debt played in their lives. Marcus Aurelius warned against judging life by appearances. Financially, that lesson remains timeless. An extravagant lifestyle often looks wealthy. Ownership often looks ordinary. But appearances rarely reveal financial reality. The person driving an expensive car on borrowed money may be financially fragile. The person driving an older vehicle while steadily acquiring productive assets may be quietly building lasting wealth. The world celebrates visible consumption. Wealth is usually built through invisible decisions. If Harry and Tony had switched loans, they would have switched futures. Because the true cost of debt isn't measured by the interest rate. It's measured by opportunity cost. Every dollar used to repay Harry's wedding loan was a dollar that couldn't be invested. It couldn't grow in an index fund. It couldn't help buy a rental property. It couldn't fund a business. Instead, it disappeared into a debt tied to a day that had already passed. Tony's repayments were different. They were supported by an asset still creating value. His debt became smaller while his income became larger. That's the difference between a liability and a productive asset. One continually takes money. The other has the potential to generate it. Throughout history, wealthy families have understood that ownership, not consumption, is what creates lasting financial security. They don't simply earn income. They build assets that continue producing income long after the initial effort. Ownership creates options. Consumption creates obligations. The difference may seem small today. Over 20 years, it becomes enormous. Most consumer purchases lose value quickly. Cars depreciate. Phones become outdated. Fashion changes. Even the most extravagant wedding becomes a memory. There's nothing wrong with enjoying life's milestones. The danger begins when borrowed money finances consumption that your future income must struggle to repay. This is why discipline matters more than intelligence. You don't need to master complex investing. You simply need the patience to separate wants from opportunities. Seneca wrote that wealth consists not in having great possessions, but in having few wants. Financially, that's really a lesson about freedom. The fewer unnecessary obligations you create today, the more choices you preserve tomorrow. Harry wasn't trapped because he earned too little. He was trapped because tomorrow's income was committed to yesterday's consumption. Tony became freer because his investments helped produce future income. This leads to another overlooked principle. Cash flow often matters more than income. Someone earning $200,000 a year can still feel trapped if every dollar is committed to debt and lifestyle expenses. Someone earning much less can steadily build wealth by owning assets that generate additional income. Income depends on your work. Cash flow increasingly depends on your assets. That's why wealth usually follows a predictable path. Income, saving, investing, ownership, assets, systems, freedom. Debt isn't excluded from that journey. It becomes useful only when it helps acquire productive assets without creating excessive risk. Disciplined investors don't ask, "Can I qualify for this loan?" They ask, "Will this loan help me own something that creates more value than it costs?" Of course, every investment carries risk. Businesses fail, markets change, property values can decline. Good debt is never an excuse for careless borrowing. It requires research, patience, and sound judgment. Now imagine meeting Harry and Tony 10 years later. Harry has finally repaid his wedding loan. There's relief. But nothing remains except the memory. Tony has also repaid his loan. But the business remains. Its profits fund new investments. Those investments create more assets. Each asset makes the next opportunity easier. That's how wealth is usually built. Not through luck, not through shortcuts, but through disciplined decisions repeated over time. Research from institutions such as the Federal Reserve consistently shows that long-term household wealth is strongly associated with ownership of appreciating or income-producing assets, including businesses, retirement investments, and real estate. Before taking on any loan, ask yourself 3 questions. Am I borrowing to impress people or to improve my future? Will this loan create an asset or simply another bill? If my income stopped tomorrow, could I still manage this debt responsibly? Harry and Tony both borrowed money. Both got married. Both began married life with debt. But only one borrowed to build something that kept working long after the loan was repaid. Every loan makes one of two promises. It will either ask your future to pay for your past, or it will help your future become stronger than your present. And over a lifetime, that single decision often becomes the difference between simply earning money and building wealth.